Hey everybody, welcome back to 5 Minute Financial Markets. Nice bullish move today. Look at this. Nice green candle up 1.35%, eclipsed the Friday high, and closed right around $400. Confirmed the upward channel. I'm still targeting, as we've talked about many times before, 408 to 410. Although I will say this 200-day moving average is coming in at 405. And so I will probably take off some of my length at 405, maybe roll off a third of my position, keep the other 2/3, and look to sell those at 408 to 410. 405 is a key level, not just because the 200-day moving average is coming in there, but $5 increments, I've talked about this before, are very key with the SPY. So you look at the intraday chart, this is the 1 minute chart, and we started off down a little bit, got down to almost exactly 395. Right here, and then just channeled all the way up through these parallel channels, closing right under 400. It actually popped up above 400. I think it got to 402 cents and then closed just under 399.95. A couple of interesting things on this chart. First of all, again, those $5 levels are very key. You find a lot of support and resistance at those $5 increments on the SPY, so keep that in mind. The other thing is, this happens quite often with the SPY. If you're looking at the smaller time frame charts, like a 1 minute chart, it'll trade in these parallel channels the entire day. Sometimes it'll be 2 or 3 different channels throughout the day. There'll be some news that comes in the middle of the day that'll change the trajectory. But sometimes it's just one channel the entire day. And look at this. By right here around 10 a.m. Pacific, we could see the two bottoms. We could create this parallel channel, tie it to the tops here, and we've got this middle line that's serving as support and resistance along the way. Big resistance there, there. And then we've got this second channel that we put in there that shows the midway point inside this midway point. So you get to like quarter channels. And look at that. Support, support, resistance, resistance, support, 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 support. So when you see this kind of parallel channel developing and you can track it, now again, I want to be very clear, it doesn't always stay in these parallel channels, but I would say at least 60 to 70% of the time, if you can identify the channels early on, you can trade around this throughout the day and just buy very short dated calls just out of the money at the bottom of the channel and sell them at the top. Buy them at the bottom, sell them at the top, and you can just clip these back and forth throughout the day. You got to have tight stops in place because if it does break out of this channel, which it from time to time does, then you want to close out that position before you lose too much. Another thing to keep an eye on, if you see the S&P just grinding higher throughout the day, not having big run-ups and big peaks and valleys, but more like a higher high and then a higher high and then a slightly higher high and a slightly higher high. If it keeps making just very slightly higher highs throughout the day, chances are it's just going to continue to do that and continue to grind higher and close the day near the peak. So if you're long on a day like that, have patience. It will usually pay off. It's good to have trailing stops that'll keep you from getting run over if the market does drop down. But again, when you see small incremental highs over and over and over again throughout the day, you can ride that almost all the way into the close, generally speaking. Nothing's changed in my opinion on the market. I'm still very bullish heading into the rest of this week. We've got FOMC minutes coming tomorrow morning, which I think are going to be bullish for the market. As I've said, I think they're going to indicate a possibility that the Fed is ready to pivot, or at least ready to consider pivoting, and that's going to be good for the market. I did, however, buy some very short-dated puts just in case. I've already got a lot of calls for this week because I am long, because I am bullish, but it makes sense to be careful and to hedge yourself, especially when volatility is as low as it is. The VIX keeps dropping, breaking out of this wedge. Volatility is part of the price that goes into options, so when volatility is down, the options get cheaper. Now 21, historically speaking, is not very cheap. That's still elevated VIX, but compared to what we've been seeing throughout the year with VIX trading between 25 and 30, I'll take a 21 VIX, and I will definitely protect myself with some puts. So going back to this first graphic we saw, this ODTE, 0 days to expiration, those are very risky puts because if they expire out of the money, they're worthless. But they can be good protection when you're looking at a singular event that you know exactly when it's going to happen, like the FOMC minutes, which are coming in at 11 a.m. Pacific. I bought those 0 day to expiration puts specifically to protect against a big market drop off of those FOMC minutes. I'm still delta long. I'm not delta neutral. I'm still about 3.5 to 1 long in terms of option delta. And the great thing about being long options is that you're long gamma, meaning that as the market moves one way or the other, your position grows or shrinks in your favor. So if you're long a call and the market goes up, not only do you get the price appreciation, but your delta position is also growing with the market. So it has a multiplying effect on your upside. The reason that's important on a day like this, when you have a singular event that you expect to move the market in a big way, but you don't know exactly which way it's going to move, that's a very good time to buy a straddle or a strangle, which is essentially buying a put and a call that'll protect you against big moves one way or the other. The reason that strategy is effective is because of the gamma effect. So if the price moves significantly higher, the amount that you lose on the put is smaller than the amount you gain on the call, and vice versa. If there's a big move down, the amount you gain on the put is smaller than the amount you lose on the call because of that gamma effect. So straddles and strangles are very good strategies when you're expecting a big move but you don't know which direction, especially when volatility is cheap like it is right now. I just want to note also, if you don't understand what I'm talking about when I say delta and gamma, do not trade options. If you don't understand the Greeks, you will get run over. So if you're trying to trade options, you want to trade options, learn about what delta is, what gamma is, what vega is, and what theta is, and how they change with the market moves and over time. Once you understand those, then you can start trading options. Otherwise, believe me, you will get run over. So to recap, still bullish, still think the market's heading higher, still looking forward to a slightly dovish FOMC minute coming out tomorrow, which will hopefully push the market up to that 405 and possibly even 410 level where I will be closing out my long positions. Thanks a lot and good luck out there.